Good day. I'm Martin Gago with Market Radius Research. It's Thursday, March the 10th, and we've got CEO Joseph Nakhla of Tribe Technologies joining us. Tribe targets the property management industry with software, services, and consolidation. I'm excited to have Joe from Tribe on today's call. We first met several years ago before going public, and I'm looking forward to seeing how things have evolved. The company is looking to digitize and consolidate the property management industry, which is a huge, highly fragmented industry with lots of room for improved services through digital platforms. Tribe is very well capitalized with its recent financing and supported by a very strong investor base. But please remember, this is neither recommendation or investment advice. We're here to learn about the company. Joe, thanks for joining us. And why don't you tell us about Tribe?
It's so good to be with you, Martin, and good day to everyone joining us here from sunny Vancouver. Tribe is a prop tech company that is really obsessed about solving many of the problems that one experiences through the property management experience in a condo environment or in a rental building environment. And you'll hear me today speak about those two big categories of densification. As you may know, or many of you probably have experienced, a lot of the cities are changing. A lot of people are moving away from a single family, either downsizing or moving into a condo environment. It could be a low rise, it could be a really large high rise. And that kind of trend is really triggering the change of the skyline that we all see in the big cities. And that's really one of the absolute attractions for Tribe to get into that space. It's simply because a lot more densification occurring, yet technology and services and solutions haven't caught up to the expectation of those new homeowners. In addition, the traditional problem of living in a rental building, where we call it institutional rental, is also very, very well documented. And many of us, if not experienced it firsthand, we know of people that experienced it. Lack of communication, difficulty getting a hold of people, paying your rent using old school ways. That's also another big area that we focus on. And once we've solved a lot of these problems from a management point of view, with using our technology and our services, we unlock a significant amount of revenue streams from there. By way of introduction of myself, I'm a civil and structural engineer by trade, and I got bitten by the technology bug really early. I was a COO of a company called TO Networks on the TSX for many years, and that company was purchased by PayPal. And after that, my excitement and desire to solve some of the city problems took over. So with that being said, I'm happy to jump into the presentation and walk you guys through what we do and how we do it. So we focus on making people's lives easier in these communities. There's a long list of different stakeholders that live in these types of communities. We'll go through that. But overall, we've been very, very busy delivering an alternative to a traditional property management solution. So traditional property management is well known. Pick up the phone, you call them and you say, we sit on the condo corporation or the strata or the HOA. These are all interchangeable fancy words for describing the exact same thing. It's a council of owners that make decisions on behalf of the building. So you can go to a traditional property management company, or you come to us. And our model is technology first, digitization first, and then we still deliver the full property management solutions. And obviously, we organically have grown significantly, but more interestingly, perhaps from a speed of go-to-market, we've been able to purchase traditional property management companies and actually convert them to our service delivery model. You'll see here we've made 8 acquisitions to date. We operate nationally. This is a regulated market, so not too different than traditional brokers for real estate sales. Property management is highly regulated in both Canada and in the US. In the US, not as regulated as Canada, it's catching up. And due to that, you actually have to be licensed to operate in these markets. And then you'll also see in our financials that we've experienced 250% quarterly growth year over year. When you look at we've only announced 3 quarters of 21. We haven't announced our 4th quarter yet, but we're very much on track to hit the numbers we set out to hit. We're considered to be the 6th largest management company in the condo space and we're the sixth largest management company in the rental space. They're completely separate, different categories. It just by luck happened to be the sixth in both. One of them actually, which is the condo one, we think we're the fifth largest, but there's due to the fact that most of these companies are private, we believe we're the sixth largest in the country now.
Joe, so let's say numbers 1 to 5 in the condo and numbers 1 to 5 in the rental. Those are two totally different. Those aren't the same 5 companies. Those are all 10 different companies in the top 5 of each.
That's correct. That's correct. So they're different spaces simply because if you take the approach of traditional property management, managing condo buildings and managing rental buildings is actually different. However, if you utilize technology to kind of set up the building for while maintenance programs, then it really becomes quite a bit of overlap in between, and that's what technology really allows you to do in this particular space. And then we'll prove that, or we'll share that with you. But we have an incredibly low customer acquisition cost and very low customer churn annually with a high lifetime value. We've been busy. We haven't seen each other for a while, Martin. So let me tell you what we've been up to. So in 2017, I've seen you since, obviously, but 2017 is when the brand Tribe came out to the market to signal to communities. Specifically, we started in Vancouver saying, look, you can go to traditional model or you can come to us. Well, since then, we've grown significantly through acquisitions and organically. We made an acquisition, one of our bigger acquisitions in 2020 that allowed us to be a national player. We acquired a company called Gateway, which is completely rebranded now and operating under the Tribe brand in every market. We've gone public in March 21, so almost a year ago. And we did that through an institutional round with an RTO, a stub receipt round, and we raised almost $13 million at the time. And we just closed an oversubscribed private placement financing led by round 13, and the majority of the institutions that came into our public round re-upped again into this most recent round. So set out to raise 15 million, and we were fortunate to have an oversubscribed round, and we had to actually turn some of the money down, but it was 21 million is what we ended up taking at the very end.
So on these recent rounds, Joe, you've raised what, 35 million, which is pretty good. How much have you raised, or how much has been put in total into the company since its inception, or from sort of an inception date?
Yeah, so knowing that there's $20 million in our treasury currently, we've historically raised 13 million prior to going public.
Okay, and how much money before that as a private? And that was the total?
It just happened to also be 13 million prior to going public, 13 million at the public transaction, and then since then 21 million.
Okay, so that's 26 plus 21 is 47 we're at.
You got it, yeah.
Okay.
So, and you know, when we speak about the technology infrastructure that we've been able to build, that's what makes us unique and really have the largest platform that exists anywhere in the space. I'm not referencing Canada, I'm referencing globally. So what is the problem we're solving? Well, if anybody's lived in one of these communities, there's quite a bit of lack of communication, very, very paper-based, lack of consistency in the service delivery. You have good experiences, bad experiences from the exact same company. There's lack of transparency. So if you sit in these communities, you know, this wasn't as big of a problem when condos were $75,000 or $100,000. It's changing now when your entry point in many of the markets in Canada is $1,000 to $1,200 a square foot. So, you know, your $1,000 2-bedroom is, you know, knocking on $1 million, 1.2 sometimes. And, you know, you really need a lot of transparency to understand what's going on with the building. And then there's also this ticking time bomb, unfortunately, that's not discussed enough, of shortage of licensed people. The work that's being done by the property management companies in North America, well, specifically in Canada, requires licensed people. These people have to be licensed through the real estate council, and there's not enough of them being produced. Simply, it's not attracting. The industry hasn't been able to attract talent due to the fact that it's antiquated, paper-based, you lack balance. And this is an area that we've been able to really flip it over its head at Tribe. We act and function as a technology company. So we're able to attract a different profile to these jobs that are traditionally attracted a different kind of older person in their career. Whereas in our case, we're actually attracting people straight out of school, which is great because they're very technology friendly and they actually want the balance and they want to enter into the industry, just haven't found the right company that kind of matched up with their values. The way we deploy our technologies in these communities and the way that our service delivery is very different is we begin by actually providing every single homeowner a full app that interfaces with them on behalf of their home, in addition to the building as well. And we have a two-way marketplace, which I'll be touching on, where we actually curate services very specific to the homeowner's requirements and needs. We have an artificial intelligence platform that runs over the technology and the data we have to continuously benchmark the performance of every category in the building. So condo corporation members can actually know how they're doing versus other communities. And then on top of all that, we have digital shared services for our communities. Think of your traditional amenities and bookable items or historical data. These things are historically difficult to find. On our application, it's always a finger tap away. And on top of all that, we do the full property management in the community. And I want everybody that's listening who isn't familiar with the space to not think that means we do the cleaning or we do the repairs. No, we actually, through our platform, commission these things on behalf of the community. So when we say we do the full management, that means that service providers interface with us using our technology or our platforms.
So just to be clear, you don't hire the cleaning service, you don't have janitors and so forth on staff, but as the manager, you would contract out to a larger company, presumably, and make sure they come in and have appropriate cleaning and maintenance and things like that. And you guys just make sure that it's done and that identify any problems or issues?
That's exactly right. Your maintenance fee, if you live in a condo community, your maintenance fee, rule of thumb is, 5 to 10% of it goes to services for the property management company. The rest of it usually goes towards the items that you indicated, Martin. And we do not have those types of actual, locksmith and drywallers and cleaners. All those guys are independent. They're not on our payroll.
But you guys aren't like Mr. Roper, where you go in there fixing the guys. You just call up your service providers, get professionals in there, and get the job done.
Correct. So in the case of a condo, you are responsible for your four walls. We do have interesting services available to you on our platform that you can take advantage of, whether experienced, certified, or leverage group buying power, because there's many owners like you that would want to take advantage of the services that we could have highlighted there. But in the case of a rental community, think you live in an apartment building downtown, in that particular case, anything that really requires repair or fixing in the unit itself is actually the responsibility of the landlord. We're not the landlord, we're the property management company representing the landlord. So we actually take care of that. We don't roll out a person to fix it. We actually, on our payroll, we actually contract out a third party that uses our platform to get the ticket, and actually they go and do the work, and that's paid for by the landlord.
Right.
So how do we make money? 3 revenue streams. It's actually multiple revenue streams, but 3 buckets we put them in. First bucket is our what we call MRR, monthly recurring revenue. That's our software and service revenue that we charge the community. So in the case of rental, we charge it to the landlord, and in the case, and it tends to be a percentage of the rent roll for the community. And in the case of a condo community, it's a price that's being charged to the P&L essentially of the corporation of the building, and it's a line item so it's not individually paid to us by the homeowners. It's coming through the treasury of the building. That's one big bucket, and that represents 70+% of our revenue, and it's very healthy. And I'll unpack that for you in macroeconomic view shortly. We also have transactional revenue. That's an interesting revenue stream, whereby due to the fact that we've digitized these communities and we have workflows around all the activities that need to occur within there. You're a homeowner, you're thinking of, you need to get your hands on historical minutes or documentation because you want to sell or you want to buy in a new community. You can actually commission that off the platform and actually pay a transaction fee. You want to pay your maintenance fees using credit card, you could do that. You want to pay your rent using credit card, you could do that. You want to buy or you want to book the amenities downstairs and there's a cost associated with it, you could do that. It's a long list of specific transactions between either the homeowners or the condo corporation and the platform and the data. We call that transactional revenue. It's pretty sticky business, and we have enough track record now to point to it from a numbers point of view. And then the third bucket of revenue opportunities for us is what we call digital services and partnerships, which is the point, Martin, you were touching on earlier, which is the ability for us to curate solution providers, best in class. We negotiate with them really, really great solutions, unique solutions for our homeowners, and put that in front of our homeowners to transact with if they wish to. And this could be insurance. Condo insurance is a massive problem in Canada, as many may know. Tenant insurance is another one. Think of it as an in-home marketplace. We just started working on that less than 5-6 months. Our data is just really early, but the conversion rates have been phenomenal. And it's phenomenal due to two things. Number one, the captive audience of our homeowners, actually, we know enough information to put things that are relevant to them in front of them. And the second thing we do is, due to our size now, we're servicing almost 100,000 people in Canada, we can actually start really negotiating some really higher level of discounts for our homeowners than a traditional person can by picking up the phone and execute on a deal. And this could be triple play, which we have a great deal with TELUS to offer our homeowners. And I can go on. There's many, many multiples there, and I'll speak about that shortly in terms of categories.
No, but that would be something, let's say I need my dishwasher repaired or something like that. You have a preferred service provider, you can hit it on the app and you get a preferred rate or something like that. Or your TELUS triple play, or the local pizza joint around the corner has a deal for you guys.
You got it. So historically, because we just started and we're just cutting our teeth on it, we haven't been able to do a ton of the local work yet. We're just growing that team right now. However, most of the deals we've done are either regional or national, so provincial or national, like the names I mentioned. I'll share with you some other ones. But the goal is exactly where we're going with it, Martin. You nailed it right on the head there. The goal is to really allow local businesses to actually be more relevant to these communities. I've done it personally, where I've walked by and I looked at some of the businesses that are kind of either in the downtown core and any of those hubs where a lot of the big towers are coming around them. And I walked in and I said, hey, do you know, you're a hair, you're a barber or a small deli, do you know how to market into these communities around you? And the answer is always no, I don't know. I want to get some of that business. I hope they walk by and see us. But wouldn't it be amazing if we give them a tool that says, hey, for everybody in the building, I'm your neighbor, Joe down here, you come and buy a coffee and a muffin is on the house, for example, the next 2 hours, here's the code. I'm just using that as an example, but it's a real life example. The other thing I want to bring up, and I want to bring up to the audience as well, because it's something that it's not discussed enough, is this concept of master planned communities. This is actually now the norm. If you look at a significant amount of projects that we're working on across the country, there's actually a ton of those master plan, what we call mixed use communities. These are communities where there's multiple towers under one developer. Some are rental, some are condo, some are very high end, and some are maybe low rise, bigger, more suited for a family. And they also have retail in them. And we want to connect the dots between these particular businesses and these particular people that live in these communities to actually make it feel more like a community, frankly.
Like a tribe, perhaps?
Like a tribe, thank you, well said. So 2017, when we first came up with the brand Tribe, most of the slide would have said a whole bunch of zeros because we had just started kind of to see what the market appetite is for a solution that's as disruptive as ours. And I mean that in a positive way because, everybody knows a traditional property management model, but nobody knew about our model. Well, fast forward as of the end of the year, we have almost $12 billion of total assets under management. This is actual concrete and real physical assets under management. We still do quite a bit of commercial, which was what I was referencing now, because a lot of the buildings that we manage also have some retail in them or commercial in them. So that's still a part of what we do. We do a tremendous number of rental units on behalf of REITs and big family offices. Almost, just on the condo alone is almost 30 million square feet under management. And what's probably more interesting here for everybody on the call is we have about $500 million collectively that go through our rails annually. What does that mean? It means that we're responsible to collect them and responsible to pass them on to their rightful, payables. But we also have almost 350 million data points about the communities that we manage. These are really interesting because when you start stitching them together, you actually start getting to really, really interesting insights into efficiency of the community, areas that the community can save money on, areas the community can take advantage of because they're further ahead in the curve than others, and best practices that can be shared between them. And we're really just cutting our teeth on that. This data is growing faster than we've been able to action it. Frankly, we've been very busy, as you can tell, but that's an area of tremendous value for all involved, our shareholders, our homeowners, our communities, to help them lower their carbon footprint or improve their economic standing. I can go on. There's some really interesting opportunities within that market. The Canadian and US market are massive. Within just the Canadian lens alone, there's a significant amount of condos that are being inserted daily and annually. There's almost plus 200,000 condos being added to the market in Canada alone. About 30% of that tends to be for investors that will rent them out. So that's an interesting overlap as well, opportunity for Tribe, where we manage the building, but we also know we have investors buying into that building that want to rent them out, and we have the tools, technology for that specific segmentation. And then there's also the full world of, big family offices, big pension funds, big REITs that are actually building brand new rental communities or continue to buy or sell and trade in between them. These communities that require management within them. So it's a monstrous market, and you'll see more and more of us, frankly, moving away from single families into communities of this ilk.
You're about to hit what I'm about to ask. You're only operating in Canada right now? That was my question.
Yeah, that's exactly right. The problems we are solving are very much Canada, US, and very much global. It's not a week that goes by where we do not get reach-ins from anywhere in the world with people looking for solutions in our markets. But due to the fact that we're delivering a holistic solution, which includes not only just software, but we're also delivering the service on it, you need to be licensed into these markets. Now, some of the intent of this slide is to really illustrate and drive home a very important point. Our addressable market is not to be in every province, in every state, in every market. We just need to be in the dense cities. And that's where almost 75-80% of the addressable market for us is, which is monstrous. There's $110 billion being spent annually to maintain condos in Canada and the US. I'm going to repeat it again, $110 billion being spent annually to maintain what they call HOAs in the US, associations or condo corporations, or what we call out west stratas. They're all interchangeable. They're all the exact same word, just to maintain them. That doesn't include the spend inside the four walls. This is just to maintain the community itself. So we really think we're incredibly well suited to get a piece of that action. I mean, as I mentioned earlier, we're only doing $500 million of that right now. So it's a massive market, completely fragmented.
So that's not the amount they includes what they spend on plumbers or whatever. That's just the property management fees and that. Wow, that's a big market.
That's the property management work being done. So it could include plumbers, but for the building, not for the individual unit. So any renovation Martin is doing in Unit 604 is not included in that number. Any sales being done, it's not included in that number. It does not include rental as well. This is just purely, we're going to power wash, we're going to do landscaping, we're going to pay the property management company, we're going to do the cleaning, so on and so forth. I won't spend too much on this, but we break our service delivery level into these buckets. We've got developer tools, a number of applications and tools very specific to the needs of a real estate developer. This is the digital strategy. This is, smart building technology being integrated to our platform before the building is completed. This is solutions for concierge. This is solutions. How is the building going to function once a developer completes it? And the developer is really interested in telling that story coherently through pre-sale. He wants to pre-sell this and let the people know that are about to buy in that in 2-3 years, this community is going to be thriving due to the fact that it's tribe managed, and look at all the technology that will be in it already. So we have a long list of items and tools for them, including digital manuals so you no longer receive a booklet when you move into your condo. It's actually completely done on your Tribe app. Including all the warranty management workflows associated with the pre-delivery inspections and post delivery. So once you've moved in, you realize there's issues with the unit and you want to communicate that to ensure that that's warrantyable. Then we have community platforms. This is the platform and the apps that really exist once people move in and start living in these communities. We do have the full management services, including the back office requirements with interaction and integration with all the accounting systems. And then we have landlord tools. Think again now from a different lens. A landlord tool and requirements are very different than strata requirements. A landlord tool requires, listing services for your units to be, listed in different multiple places so people can apply. Digital applications, digital check, credit check and other checks, awarding lease agreements and doing all that digitally, moving the people in, allowing them to pay their rent, so on and so forth. This is a long list. Move in, move out reports. All that stuff is done in our technology that's already proprietary to us, built in-house.
Sorry, I'm just thinking everything through here. When you say land, are you guys the landlord, or is that technically someone else?
Yeah, so the landlord definition is the person or the company or the entity. Could be as big as a REIT, pension fund, could be as much as Martin deciding to buy a condo and wants to rent it out.
Yeah.
That's the landlord, but the landlord tools would be tools very specific to aid you to do the work, or if you hire us as a full management company, and you can, then that's the tools that we use to do the work on your behalf.
So let's say you're running a rental building and you're taking in tenants. We Suite 301 opened up. We post an ad for it. It could be structured where you are the one. Tribe is the one who interviews the ad or posts the ad, takes the applicants in, then interviews them, then figures out the rental rate, what's a good market rate, and then says, okay, we've done your references. We'll choose you as our tenant. Or the owner or some other third party could be doing that?
Yeah, so the former, essentially. So we are the ones that do that on behalf of some of Canada's largest REITs. Okay. So a good example would be a REIT overnight decides that they're going to purchase a rental building in Edmonton. I'm just using it as an example, or Calgary. This happens actually daily. Let's take a real one we're experiencing right now. A big REIT out of Toronto purchased a large rental building, full asset in Victoria, and they've just called us and said, look, this is what's going on, we're taking it over. We become the complete back office service provider on their behalf. They don't need to do anything. We do everything associated with that on our platform, in addition to some of the hand over the keys and so on and so forth that's required for the building to operate.
So this pretty, I've never really thought that much through on the I assume big REITs would have their own property management systems in place, and that's part of the leverage and expertise they get from being big multi-billion-dollar asset managers as they do that. But they don't do that. They hire you to do that.
Yeah, they hire us. There's occasionally a smaller team that might work in an area where they have quite a bit of density. But I will tell you two things that are bang on. I could tell you this from personal experience. Number one, nobody wants to deal with the management. It's incredibly difficult if you have not brought it into the 21st century and invested in the technology back office. It's very difficult to do unless you had the genuine scalable tools that we've been able to build. Number two, the big money being generated on the REIT side or the big family office side is actually on the real estate asset value and trading them in between them versus the actual revenue. They do need the revenue, otherwise the asset won't be worth it. So they just need it to be humming along, but that's really where the big opportunity for them is.
Okay.
So speaking of complexity, this is why property management is difficult, because these different stakeholders need to coexist, and they all have different definition of success. And what we, and I say that with humility, that our engineering and product teams have been able to build some fantastically smart technology that allows all these people to coexist in one platform, but still find it to be incredibly simple. So we know what you're set up to do. We understand the iceberg function here. You want to click of a button and do X. We understand that there's quite a bit of workflows that have to happen behind the scenes. And we've been able to build this very large platform that really can look so simple when you download it and interface with it. But these are the different stakeholders that have to exist in our platform, and have to do it harmoniously to ensure that your needs are met and your buildings managed properly. And this is an interesting view on the fact, a lot of people think we only manage existing buildings. We actually have almost double the number of communities, or the number of homes that we've already, that are up and running in our backlog to be launched when the time comes, when the construction is completed. So very specifically, there's multiple developers we work with, I mean, in the tens, who are building communities that will be erected in 6 months, a year, 2 years, 3 years. And they're not up and running yet. However, our technology is still working. Our technology is still being used between the developer to communicate directly with the homeowners that haven't moved in yet, keep them updated. Or as they enter closer to the different completion phases, the developer use our technology to manage the construction quality and actually manage all the deficiency management. And then, they start communicating with the homeowners and say, hey, book, using Tribe, book your date to do the walkthrough and the QA. And then, by the way, here's your manual. And then your congratulations, here's the day where you're going to book your elevator on the platform so you can move in. And by the way, you can buy these products and services on the platform that are already pre-negotiated on your behalf. So you can see we get involved way before the building is completed in many times. But there are also buildings that are 30 years old, 40 years old, that have been traditionally managed, that still call us or reach out to us and say, can you come in and give us your full solution? So what do we focus on? As an organization, we've got two big areas of focus. Number one, we want to continuously increase our footprint. We want to increase the number of homes that we manage. So we do that two ways. We have organic growth, and I'll speak about that in a second. We have non-organic growth, which is through M&A, where we go and acquire companies and convert them into our digital service delivery model. The second big area that we're focusing more and more on is actually enriching our service offerings to the homeowners, because we want to get them a lot more value that they can leverage when they are a part of a tribe community. And I'll speak about that. We spoke already about that in terms of what services and offers we can put there, but I'll share some data with you on that. Organically, we have had a great 2021. I mean, I will, I hate to bring that into the conversation, but I can tell you with absolute confidence that our business is recession-proof, our business is pandemic-proof. These buildings will have to be managed no matter what happens. And you'll see in this particular case, as we increase our footprint, there's actually a lot more communities that reach out to us seeking our service delivery model to be put into their communities. So you'll see in 21, we had 503 leads that come our way, from, increased by 269% from the year before. Cost per lead has gone down significantly. So a lead would be a community that's seeking our services. And when we decide, qualify or disqualify, however you think about it, the community and its suitability for us, we win 30% of the ones that we bid on. And the average lifetime community value is about $683,000 for us, simply because we just don't lose a lot of communities. We operate on revenue less than 3.5% churn. And my definition, Martin, you're an analyst, so you appreciate this. My definition of churn is not funny math churn. My definition of churn is, how many homes did you start with and you get them all tagged in January 1st? How many homes of those do you still have in December 31st? And when you do the math on that, it's 3.5% churn. Like, we lose 3.5%. We still grew by 250% year over year. So we grow significantly, but that's the real genuine churn number. And that compared to the industry of about 10 to 15%.
And what is the terms of your contract? Is it, I presume it's just not 1 year that you'd want to set it up. It's a multi-year thing, and then there's options to extend. Can you give some broad parameters on what an agreement looks like?
Yeah, absolutely. So in the condo corporation relationships, it is 1 year because it gets ratified and re-upped again every year in the AGM. I will share something with you and the viewers that you might really appreciate. Historically, traditionally, every property management company uses a similar institutionally written a contract. It's called the agency agreement. Basically, in the agency agreement, you and I are old enough to remember the days in the 90s when cell phone companies kind of held you hostage to your number. If you remember that, you could never fire or you could never get rid of your cell phone company because they would keep the number and make it so difficult for you to leave. We actually struck out of all of our agreements the ability for us to be difficult to fire. We actually made it really easy for every property that we contracted with to fire us. We said to them straight up, if you don't like the service that we're offering you, you just need to get the board to view. No, you don't need an SGM or AGM or any of that stuff. Just let us know as a board that you want us fired and we're gone. We'll give you your data and we're gone. And we still have 3.5% churn, simply because you live and die by your performance as an organization. You don't just go out there and make it very difficult for people to fire you. So I know this is counterintuitive to most people that listen to the way I position that, but it's actually the way the future has to be. We need to be able to say, good service, I'll keep it. Bad service, I don't want it. And that's how we treat it. And frankly, people lie, numbers don't, as you know, Martin. So our numbers don't lie.
So with because in some ways you're digital and more efficiencies, so I would think you can operate or manage a property more efficiently, but you're adding greater services and more value. Are you able to charge a premium, or do you charge a discount because you've got a lower cost base, or can you just talk a little bit about how you price your service compared to your competitors?
Yes, I think you're asking me to look at the slide. So let's jump into it.
Sorry, I made you go ahead.
It's all good. It's all good. So very transparent in the way we do this. So look, industry is on the left. This is average. You got to remember we have some geography that has to be managed a little bit, but generally this is what you're looking at. This is also pretty much consistent with all the companies we look to acquire anyways, and we have a very active M&A team. So we know what the industry charges really well across the country. So traditional property management company will charge $20 MRR, monthly recurring revenue, plus $2 operational transactions. Now, everything I'm doing here is comparing apples to apples. So their definition of operational transactions is exactly like ours. $20 monthly is the service fees that they charge. They're 30 to 35% gross margin and 10 to 15% annual churn, as I mentioned.
What's an operational transaction? What does that count?
If you remember earlier, I'd indicated that we have three revenue streams. One is the recurring revenue. One is the ability for the homeowner to interface directly with our application or with us to get things done like documentation or permits or pay their fees or book an amenity or what have you. That's the definition of a traditional company's operational transaction. Ours is much larger. You see it's 6, it's almost 300% of that number, simply because we have more. So when you digitize the community and the home, you actually give yourself a much better chance for the homeowner to find information themselves, and they're willing to pay for it. Not much, but they're willing to pay transaction fees for it. Okay. And 10 to 15% annual churn, and I define churn in the last couple of minutes with you, but I do want to make a point here, which is heavy regulated markets, such as British Columbia, have lower churn, simply because the regulation forces the more licensed people to really behave in an appropriate way. So there's less problems that tend to be due to the conduct of a property management company. So there's less companies that get fired. Still 10% annually, which is very high. You go out east, start going to Toronto and markets, although Toronto is catching up, the Ontario market is bringing in a lot of the BC type of regulation. And it brought it in December, but it's kind of grandfathering it slowly into the market. And you get to a little bit more closer to 13 to 15% churn. And you'll see apples to apples here. The last 3 quarters we've announced, we're running at about 50% gross margin, 4% churn. Our gross margins include the exact same types of items that they would include in a traditional property management company, in addition to hosting services, onboarding buildings, all the additional services that we do. So we actually have more COGS, if you believe it. Yet we're still operating on a much better margin. The final item which you asked about, which I want to make sure that everybody understands. So we're comparing apples to apples here. $20 MRR per home on the traditional side, 26 MRR per home on our side, $2 operational transaction on one side, $6 operational transactions monthly on our side. And then we start layering on what you mentioned earlier, Martin, which is the additional services that we can actually generate more revenue from, which frankly, traditional property management companies do not have. These additional services that we're offering, we disclose to the homeowner or to the community what we actually make money on. We actually are transparent with them, and we just let them know what we actually generate from that of it, and they are happy to see it because it's convenient for them and it saves them money. So that's the end of the day, you know, it's a true, genuine win-win here.
Great.
I skipped this slide about M&A, and I want to speak, maybe spend a minute on that if it's okay, just to let everybody know, we don't just buy traditional property management companies and then leave them there to recognize their top line revenue. We actually integrate them, fully integrate them into our ecosystem. So we start with our IT infrastructure, then we start really optimizing the service delivery. We digitize all the assets in the buildings, in the communities, to put them on our accounting system and start improving the quality of the financial statements there. And then we improve the profit margin that obviously naturally comes out of there. And then we also convert all their brands. So the markets they're operating in, I call it, we go from defense in that market to offense. Okay, and then we put our you know, lead generating engine into that market. We start getting the word out about the service delivery. There's a new opportunity for you as a community or a building to come to a different service delivery model than the traditional one. So that M&A team is responsible for 7 acquisitions, as you can see here. And we've made another one that's an 8th one that's non-related to property management. It's more of a software company. And then we continue to identify good partnerships and bring them up. Yesterday, I just announced a partnership with a company called TUT, which is a home universal gym product that has a tremendously cost-effective price point, as well as a small footprint. It's actually designed for communities like we manage. So, you know, not your old school universal gym that's massive and big and you can't move it. This is actually really designed with a whole bunch of pulleys, and it fits into a very small footprint. And our partnership with them is to make that available for our developers to bring it into brand new communities. And instead of having a full massive gym for everybody to use, which is rarely used, frankly, we have the data on that, it actually can be available for each individual unit. And then also we're working with them to create content, workout content designed for people that live in smaller square feet units, which is also another big ask. And then don't forget, overwhelming majority of communities don't have gyms. Overwhelming majority of these communities are not coming up with these types of amenities. So these amenities have to work their way into the 4 walls. So speaking of that, here's a pie chart of a household, average household family spend related to their home. So there's other items that everybody spends money on. They're not here. This is really the average of areas that we believe we can influence in a positive way. We can give them more products and services into that market. And you'll see it's a tremendously massive pie that we're just cutting our teeth on. I bet Amazon somewhere somehow has this in an incredible amount of categorization. But in our case, what's unique is this is just related to you and your building and your community. So we're not going to own any of the products you're buying. We actually just bring these products curated for you, and you actually rate them. You have the experience with them, and you either become a big user of these products, or you can even start recommending them to your neighbors because they've done a great job for you. So I told everyone, including you, Martin, that we just started working on these things. Here's some actual early data conversion rates. Apollo is what they call InsurTech, which is a digital insurance provider for condo and tenant insurance. You'll see here that we launched in July 21, and we know enough information on your behalf. We know the square footage of your unit. We know the length of the building. We even know the historical events of your community. So on your behalf, we can, with your approval, we can actually send that data to Apollo, come back to you with a condo underwriter, 1 or 2 or 3 underwriters proposals. And we've got 15% conversions on that, which is amazing. Now you should know, and for anybody here that either owns a condo, rents out a condo, what have you, you should make sure, I'm just doing this as a PSA, make sure you have a condo insurance, not because the building or the strata or the condo corporation has insurance, that means you have insurance. You have to have your own condo insurance, number 1. Number 2, make sure that your insurance policy can cover the deductible of your large building policy. So God forbid, if your unit is responsible for creating a leak that's going to trigger the large policy for the building, make sure that you have enough coverage there. This is a free advice I'm giving everybody that will listen. You can go to Apollo, you can go to Square One, you can go to your favorite insurance provider, just go and get it done and make sure that you have it. Why am I doing that? Because 60% of Canadian condos are either underinsured or not insured at all. That is the number 1 reason why we have this massive premiums growing on the building itself, which is still affecting homeowners simply because they're all chipping in the increase as it comes out of their maintenance fees.
Gotcha. So that means if your toilet overflows or whatever and spills out and leaks down 10 floors and damages other people, that way it's partially covered by the building insurance, but your own insurance will then cover the shortfall of the deductible.
Correct. You're responsible for that example that you mentioned. So you want to be able to lean on your insurance company to say, look, my unit caused this, so I need to, and then it gets big enough in the example that you've used, by the way, which happens every day. Like this is not unfortunately, it's not an exception, it's the rule. And then usually the damage is large enough that it triggers the large building insurance. So make sure that your insurance can cover the deductible that triggers the large insurance policy.
Makes sense.
And then finally here on the right-hand side, this is our partnership with TELUS Triple Play. If you ever lived in or moved into a brand new condo, you usually call, figure out which company you want to go with. There's multiple service providers for Triple Play. Usually is an offer, but they don't know when to come in and what day to move in. They give you 4 or 8 hour window. Well, on our application, you receive a special offer. And that special offer is not available on the street. So you're actually receiving an offer that takes advantage of the group buying power. And then you actually can get it all booked and ready to go before you even move into the community. And you walk in and it's all ready to go. 20% of people in brand new communities that we piloted this in bought the offer, which is fantastic.
And I would think companies like TELUS, where those are big MRR companies with fat margins and so forth, they provide you good sort of finder fees or commissions off of that type of thing.
They do. I don't know if I'd say that I'm loving every dollar again. I think we can get more. We deserve more, but in the same time, size matters. And as we continue to grow, that gives us a lot more leverage to be able to negotiate the right deals. However, make no mistake about it, I'm not complaining. I do think we're just delivering incredible value because these leads they're more than qualified leads. These are perfect customers. That's what we're delivering, really. Some examples of communities and developers that we work with. We work with almost 60 plus developers across the country, not 60 plus projects, more than that, 60 plus developers across the country. And this is some examples of it. What I don't want anybody listening to our story here walk away thinking that we're really just focused on high-end communities. We got plenty of those. But any community, doesn't matter how expensive per square foot entry point is, same goes for rental. All these communities are still under the exact same work that's required. Yeah, there's different types of customization needed per community, but we work with all kinds of different communities, suburbs, in the heart of the downtown, $3,000 a square foot, $400 a square foot, it doesn't matter. They all need the same level of care.
So, sorry, I was about to ask that. So on a $400 square foot, like a sort of cheaper, more rundown place, older, you're good at in that market as well. Or do you tend to get more market share in the sort of newer, more premium buildings, though?
All the above, I'll be honest. The best way to look at it is this. Density obviously affects the dollars. If I answer your question from a dollars point of view, of course, we just delivered a building, for example, in Ontario, that's 520 homes. Well, that's a village, right? Literally a village built on top of each other. So that obviously, that's 5 times the size of, 5 buildings, 100 units each, right? So if you look at our breakout from a revenue point of view, the answer will be, yeah, we make obviously a lot more in the total dollars from the larger communities. However, the bigger number of customers we have is actually the smaller communities, because that's the much larger footprint in Canada. And that goes also for rental. Again, we've got the really high-end, beautiful rental communities built with amenities and all the bells and whistles. And we've got rental communities that are 40 years old, that are older, and they're all communities, all places for people to live, and we manage them all. Maybe spend a minute here on our financials. So this kind of gives you an idea from our revenue growth. The top left-hand side, you'll see about $2 million of recurring, $1.9 million of recurring 2018, approximately 2.9 in 2019, 4.2 in 2020, and then we signaled to the street between 15 and 16 million of recurring in 21. We haven't announced Q4 yet. We feel very strongly about our ability to achieve the numbers that we set out to do it. And you'll also see top right hand side, if we can geek out a little bit on customer recurring revenue here, you'll see these are average monthly recurring revenue per building or per customer. And you'll see us constantly, generally being able to, despite the fact we'll continue to grow and acquire other businesses, we still have the ability to sustain the growth we're getting in the monthly recurring revenue. My favorite thing to say is we've been able to do this while not having to increase the maintenance fees on behalf of all of our communities. And I don't want to confuse everybody by explaining obviously this inflation that's occurring right now, where the work that's being done on behalf of these communities with third parties just continues to go up, just like everybody experiences personally. Plumbers are charging more and drywallers are charging more and so on and so forth. But we've been able to generally generate more revenue per customer while growing and not necessarily increasing the costs on the homeowners, taking inflation out of the conversation.
So I'm just looking at 3 of these charts here in Q4 2020 and then into Q1 2021, you've got a big jump in the average MRR by community. I'm guessing that was an acquisition that had a bunch of very large communities, so it raised the average, or can you explain what happened there?
Yeah, actually, I would tell you that acquisitions tend to lower our average.
Okay.
So when you actually look for dips, these usually indicate that there is an acquisition that was made. Because this is an average per customer. So when we make these acquisitions, most companies do not charge or do not generate as much revenue per customer as we do. So when we buy them, they tend to be lower. Now, there's multiple things that allow us to start generating more customer revenue, and I mentioned them earlier, such as the ability for us to generate more revenue, the operational expenses, the transactions that I was mentioning earlier, because once you digitize the community, you can actually start charging for more opportunities to interface and transact with the homeowners. But you'll see that. And we also have a really interesting thing where we actually correct our portfolios. So we have a good handle on our cost of goods. And if you have a good handle on cost of goods, you can actually start really mixing the right portfolios. And then you can actually identify communities that actually are customers that are actually costing you money. And there are some. And then you turn around and make corrections. You show them the data and you say either you need to come to market or you need to move on. And then you actually make adjustments there.
So, but I still don't quite understand from Q4 2020 to 21, the next year, your average MRR by community goes up by almost $1,000 or am I just reading this chart wrong? The yellow line with the gray dots, what's that big bump up in?
This is the number of homes. That is
the communities, that refers to the left.
Yes, yeah, I know.
Y-axis.
Not the most articulate chart in the world. Our apologies. What we wanted to illustrate.
Sorry, just the black bars. That is the average MRR by community.
Yes, you know.
Okay.
Yeah.
Gotcha.
Yeah.
Okay.
And we wanted to shed light on, well, how many customers do you have while you're doing that?
Yeah.
So we wanted to do it though. It's probably a better way of doing that, frankly. But
okay, so you did an acquisition in Q4 or Q1. And that added, you went from 100 and something communities up to 500-ish communities.
Yeah. Yeah, exactly. That was the national acquisition I referenced earlier.
Okay, okay. That makes sense now.
All right.
Yep, thank you.
Okay, let's talk public market here. So obviously a micro cap with a pretty tightly held long list of really outstanding institutional investors. We have about 21 million basic shares. The largest shareholders that other founders like myself or some of the biggest shareholders we have enter into a voluntary lockup. You'll see that we're buyers, not sellers in the market for the last year. And you'll also see here, the breakout is you'll see founders, directors, and management is about 25%. To be married closely with industry and strategic investors, about 40%. These are some of the biggest names in the industry that actually understand the problems we're solving and very much rooting us on to continue to grow our footprint. And then you have institutional and retail investors at about 35%.
Okay, that's yeah, that would make for quite a tight float of not even a huge amount of shares outstanding.
That's correct.
Your share price is at around 3 something right now, but you did that big financing at $4, so we're trading well below that financing price.
Yeah, where someone said to me yesterday, "This is very cheap. What am I missing?" And I was like, "You're not missing anything. You're missing the war around the world, perhaps." But
yeah.
So.
Okay. All right.
Snapshot of our people. I have to pause here and tell everyone, like, we've been able to accumulate a tremendous executive management team. People that have been there, done that. We still have the young, enthusiastic desire to continue to grow and scale, but a lot of experience in the industry. And the same goes for our board. We have an independent board. The majority of the board is independent, and that was by design. It's very, very rare for a microcap to be doing that. Our chairman is independent, and the reason we did that is because we built our executive team and we built our board not for the company we currently are, but for the company we're going to be tomorrow. So this, you're going to see more really great names addition to both executive management and the board here. So to summarize, we're disrupting a very much need to disrupt industry, outdated, paper-based. We have multiple revenue streams with track record of being able to generate that. We have very strong market penetration, both organically and on the M&A side, which also speaks to the fact that we have a massive M&A opportunity to go there and continue to tuck in these companies and convert their gross margin, pro gross margin delivery to ours. Strong cash position, and we've got, we didn't talk about that, but not only do we have great treasury, strong treasury, but we've also got senior debt available for all of our transactions, which is also a really interesting position for us to be able to be a lot more aggressive. And you'll see continuous catalyst. We're a company that's doing a lot, and not just for the sake of putting announcements. We do things that really make a difference to the life of the people that live in our communities, and to improve intrinsic value for our shareholders. So most unique thing about us, probably taken away from today, is we're the one-stop shop. You no longer need to go and get a little piece of technology, a little bit of back office technology, a little bit of IoT technology, and put it in the hands of a property management company and have another application to do this with, or a developer has to make 5 calls for different products to be brought in. We're one-stop shop. We're the most comprehensive aggregator of all these solutions, all proprietary to us, and makes life easy for all the people that use this in the different stakeholders, residents, homeowners, landlords, and so on. That's it.
All right. Well, I got a bunch of questions here to ask you. On the M&A side, what are typical metrics of valuation where you acquire? And now that, okay, let's just stick with that. What are valuation metrics in the industry?
Rule of thumb is as little as, and it's within times revenue. And I'm sure a lot of people will ask, well, why not EBITDA? I'll explain that in a second. But rule of thumb is, we tend to buy them for as little as 0.6, 0.7 to as much as maybe 1.2 times revenue. And the traditional average company tends to be running at flatline and hasn't grown for a couple of years, with a churn of about 10 to 15%. So they might lose 10% of business, but they'll gain another 10%. It's simply because it's a revolving door between companies. EBITDA would be as little as 3, 4, 5%, as much as 12, 13%. Truth of the matter is, we don't give multiples of EBITDA simply because a lot of these businesses were they're designed to kind of optimize the lifestyle of the owners. So you're really not dealing with audited financials where there's going to be line items there where cars and houses and all that stuff. So the rule of thumb, when we look at them and we normalize the EBITDA, we can get 10 to 15% businesses. But the big takeaway for us is that we know we're buying them at 30% gross margin, and we can convert that into 50%. We know we can unlock additional revenue streams. This is the high level metrics. So I'm giving you a bit of a range, but 0.7, let's say 1.2. How we buy them tends to be with 3 currencies. One is cash, and the other currency is stock, although at these prices, I'm very hesitant, but not a big fan of dilution at these prices. And then the third one is actually what we call vendor buybacks, which is basically based on the performance of the business. We'll start paying back additional revenues for that. The fourth currency that's been made available to us now, especially with a very healthy treasury, as I mentioned earlier, is the senior debt.
So going forward, you've got senior debt, you've got a lot of cash equity to leverage that. What kind of, and with this kind of a business, debt makes sense to me. What kind of debt ratio do you feel comfortable with going forward, or how much of your debt would you see yourself using to make? And that's basically that's acquisition debt, right?
Yeah, acquisition debt, correct. Yeah. I mean, operationally, we don't really need the working capital debt. So acquisition debt. The rule of thumb is, if you're buying at 1 times revenue, rule of thumb is $20 million buys you $20 million worth of revenue, but you can use maybe 5 million of that or 7 million of that for debt. Maybe 1/3 is probably the right lever. I'm kind of answering really high level because we're looking at a bunch of deals and the data just varies a little bit per deal depending on the size, but that's the rule of thumb.
And let's say you buy $20 million worth of revenue. After you optimize it and get them on platform, how much EBITDA should you generate off of that, would you expect?
Yeah, from that business, without taking additional overhead from our organization, we see that we can double the EBITDAs of these businesses, right?
Okay.
Like we see a path to that, right? And that's the function of all the accounting systems go in one place, all the HR expenses go in one place, the digitization improves the ratio from a service delivery point of view, so on and so forth. So we can actually see a path to that. And we've actually illustrated that if you look at business units individually. But because we put these businesses taken from the defense into offense, as I mentioned earlier, what we do is we invest now in their marketing presence into that market, which is most companies we're buying have not done that. There's usually not a line item that says marketing or lead generation or just telling the story around what they can do for them, simply because they're traditional, they're not doing a whole lot of difference than anybody else. But now we have a story to tell in those markets. So that's kind of usually where maybe for the first 180 days will be a little bit heavy on telling the story in that market, especially if it's geographically new to us. And then so that some of that EBITDA will go back into the business while we're still integrating it and hardening it essentially.
And when you do your M&A strategy, are you looking to do a few larger acquisitions, or can you get better leverage out of doing more smaller acquisitions? Obviously, any acquisition takes effort, but maybe you can buy them cheaper when they're smaller. What's your general strategy towards that?
Due to the growth in our size, if you were to think of all the property management companies that are available in the market as a pyramid, which obviously most businesses are, meaning a lot of the smaller ones, and as you go up to the top, there's less and less bigger ones. We continue to work our way up that pyramid. In the last 18 months, we've worked our way from, we can buy things that are $200,000, $300,000, $400,000 recurring, all the way up to now we're looking at 5 million recurring, 10 million recurring. Like we're starting to knock on those doors. So there's less and less of those companies up there. I think you're going to see us do more of that. However, there are some really interesting gems that are geographically great for us to go and make an acquisition. And they just don't have big players. They're just small. So, you know, there may be a geography in a market. I'm thinking of 2 or 3 in my head already, where like, there's just no big players. So you're actually an acqui-hire, you land, you know, so you beachhead into the market. You like the market because you think there's quite a bit of revenue streams opportunity. I mean, the addressable market could be $11-12 million recurring, and you might just need to get in to buy $1 million recurring business, and that will be enough to get you into, you know, as the bigger player there. So that's no longer the rule. That's the exception. The rule will be larger players.
Gotcha. And do you have a big enough footprint, sort of home, like footprint within Canada, where you don't have to do, you can rely more on organic, and then your M&A strategy is more focused on the US right now? Or can you discuss that a bit?
Our M&A strategy is focused on Canada, and we also see the US as a market we will be going after. We've got a number of brokers that we're looking at to represent us for opportunities in the US, and we just don't want to, you know, we're not desperate, so we've got plenty of deals to look at. So you'll see us, our organic machine is well oiled, and it continues to grow. I mean, I'm not going to say it's perfect. I don't want anybody to hear me say that, but it certainly is well oiled, and we can continue to invest into those, lowering our cost per lead and increasing the number of leads. But still, the speed of buying a company, now that we've got a really great M&A team, is you know, it's almost difficult to replicate. You know, you go buy 10, 15, 20,000 homes under management. That's very, very quick, versus, you know, getting each individual building and converting it, although we do that every day. So that particular opportunity, we're looking at a bunch of stuff in Canada, both coast to coast, and we are looking at some stuff in the US. In the US, less of regulation, a lot less sophisticated operating businesses in the big markets, but obviously the volume is massive. So we're going to be ready for that market. Okay. And with the landlords, there are some very large landlords in Canada. Are you able to sort of cut a nationwide deal with, I don't know, a Brookfield or someone like a big property manager, so that you make a master services agreement, and when you enter into a region, you just naturally take over their residential, rental, or condo properties? Yeah, so that's a great question. We do have national partnerships. What's really interesting about these, you know, let's say us and an XYZ REIT, we have a national footprint partnership. And what they usually traditionally have done is they've given their business, well, first of all, there hasn't been a company that can service them coast to coast. So that's actually been a massive problem. And number two, they don't want to put all their eggs in one basket, which is obviously completely understandable. But as we continue to make more acquisitions and actually have more presence in markets where they actually really like our service delivery in a market, and they wish they would have had us in another market which we don't exist in, by actually making an acquisition in that market, we open that door for them to start handing us more business. And we're seeing a lot of that as we speak.
Okay. All right. And what is, like, you've got very strong growth over the years. Can you, like, what is your kind of organic growth levels once you like, after a following, you get into your foot into a market? How long does it, what kind of growth do you get in the first year and second year in that?
My goal, it's been well documented, and it's put out to our executive management team. My goal is to stabilize, take the churn down. Again, you remember, you're buying businesses that are churning 10-15%, so stabilize it. And then on top of that, add another 20% year over year. Okay.
So your planned organic growth is for that. Okay. One of on your board, and you mentioned raising money with the raise that you just did with Group 14. Could you just tell us a little bit about
round 13? Yeah.
Oh, round 13. Sorry, round 13. Could you just tell me a little bit about them? Who are these? Like, it's always nice to know what kind of smart money hopefully is in leading a deal.
Absolutely. So round 13 is round 13 as a group has multiple funds. I believe, don't quote me, but I believe it's in 700 million plus under management. It's one of the largest funds that actually operate in tech and tech-backed services. And they have the venture fund. The group that actually invested in us is the Growth Capital Fund, and we are their first public transaction. They've done multiple private transactions, and the reason they felt obviously felt very strongly about our executive management team, our performance as a company. This wasn't a traditional public markets transaction. This was a private placement due to the fact that we're under the hood and looked at for tens of hours on Zoom and due diligence. So they actually really sunk their teeth deep as a traditional growth capital fund would do. And we were fortunate enough to have them as a lead. They're also joining our board. The managing director, Sanjeev Simanet, will be joining our board shortly after our AGM. And they also have a really interesting portfolio group of companies that actually are synergetic to some of the services that we deliver. So not only did they find our company to be an attractive investment, but they also saw ways where we can actually help some of their existing portfolio companies and vice versa with some strategic initiatives down the line. You'll see more about that in the future.
Right. And are there any other competitors out there that are similar to you, or is it like tech moves fast? Or are there like beyond the traditional property management guys, what about in the prop tech space? Any other people on your radar?
Yeah, so I definitely do not want to discount traditional property management companies. These guys, but you're bang on. They are the most obvious. Well, in some cases, acquisition targets, in some cases, competitors. So you nailed that correctly. On the prop tech side, nobody has gone out to attack full service delivery, the condo market, the way we're doing it. So nobody's done that. I couldn't point to one. There's a number of software companies that have built solutions for traditional property management companies to license from them. And that's a different value proposition. And there's a number of them, and I'm happy to share a long list of existing companies that have either struggled or just cutting their teeth on it. And then on the rental side, in the US, there is two companies that have actually gone out and they're expanding via acquisition of traditional rental property management companies, but not in buildings, individual homes. So if you're familiar with, obviously, the trends in places like Arizona and Palm Desert and so on, many Vegas, there's a lot of people that own homes and they want to rent them out. And there's a company called Mind, MYND, that is venture capital backed, that's going out there and actually is delivering full service using technology on behalf of these customers. And then there's a company called Pure PM, which is actually buying local, small, rental, single unit property managers and actually put them under the fold. It's an adjacent model to ours. They don't do condos, they don't do institutional rental, but that's an adjacent model to us. And the truth of the matter is, the pie is so big. We're not in anybody else's radar, vice versa, due to the fragmentation of the market.
It sounds like Mind is kind of an Airbnb, but of long-term rentals, not of short-term rentals, where they just sell the platform. Is that roughly it? But
they do the actual management itself.
Okay.
So they are the platform. They have some technology on the back office, and I don't know enough about what's in house and what's licensed.
Yeah.
But they are the property management company on behalf. So if Joe buys a really, really good deal, and I bought in 2008, I did not, but let's assume I did in 2008. I should have. In 2008, I bought like a couple of homes in Arizona and Scottsdale for like $300,000 each, and I want to rent them out. How do I do it? I'm not there. I'm not local. So you'd hire Mind. That's an option. Although they only operate in California now, but I'm just using that as an example. And Mind will go out and they'll do they'll use the technology and the service delivery. They'll hire the property manager themselves. That's similar to us in that, except we do dense, big markets, and we do condos as well. They don't do condos and they don't do rental buildings. They only do homes.
Do you license your technology out to third-party property management companies so you could just clip a license fee with very high margins?
We started there, Martin, and this is when the coin dropped in 2017, when we realized you can only be as good as the property management service delivery model. And I went back to my shareholders and I said, look, we've licensed to some of the biggest names, some of the largest property management companies in the country, and some of the property managers are using it beautifully. And the results and some aren't. And because the company treats each individual property management company as for every property manager as an individual island, there's no consistency in the service delivery. So that was my way of saying to the shareholders, let's just go and own the whole transaction and not license our technology to third parties.
So you've stopped to those prior clients. They're no longer, you don't license that out anymore.
We do not license this technology. We license our technology to developers building brand new communities in markets where we don't have full service. So we have developers maybe building something in on the coast, on the eastern coast, and we don't have any property management there. And they have a small little company there that does management. We'll license our technology in that case, but we do not license other solutions to property management companies.
Gotcha. All right. And just sort of one last question. Could you just give highlight on your financial performance? You talked about revenue, like how profitable or what's your burn rate, and how do you see that with the inflection of your growth? Growth is expensive, or it can be.
Of course. So on the cash kind of adjusted EBITDA, we anticipate in the neighborhood of burning about $4.5 million. And
a year?
A year.
Yeah.
And we see that, I think it's about $1 million a quarter. We see that really flattening due to the fact that includes your full product engineering teams, that includes all your marketing and digital content teams and M&A acquisition teams. And these teams don't need to grow as you're buying more or your revenue increase, right? So we feel really, really good about that. Of course, I'm, as an entrepreneur, and I'll never forget that, I may have even shared that with you before, but in 2019, end of 2019, I had enough levers in the organization to become profitable. Those levers haven't gone away. Tomorrow we can become profitable, but the goal for us and our shareholders, are excited about our business simply because of the growth opportunity that we've got. But we've got all the levers from a business point of view to become profitable any point we want.
Yeah, that makes sense. All right, and I guess, just as we wrap it up here, what kind of news flow should investors be expecting over the next 6 to 12 months? I guess some M&A, new client wins, maybe new partnerships. Could you just flesh that out a bit?
Yes, remember, 2 things we obsess about when we wake up. 1, we want to increase our footprint. So we don't go out there and press release every time we win a new piece of business because we win a lot of them. So we don't constantly say that, but there are big master plan communities that are in the docket. When we win those types of communities, we'll be communicating them out to the street. You'll see us be active on the M&A side. And again, we don't just go out there and say, hey, we wrote an LOI, look at us. We're more like closed, this is done. So and as you're moving up on that pyramid and you're buying bigger things, take a little bit longer because you want to buy right. So you'll see a lot of activities there, and you'll see a ton of activities around partnerships. We are very, very active in bringing in some great solutions to our partners, to our homeowners, and those partnerships obviously represent either recurring or transactional revenue for us.
Joe, thank you very much for taking the time to talk with us. That was really good. I'd love to talk to you again in the future as your business builds out. So thank you very much. Have a great day and talk to you again soon.
Thanks again, Martin. Thanks, everyone. Enjoy the day. Take care. Bye-bye.
Cheers.